Hello all and welcome to the third part of the topic Basics of Accounting. Now in the last two sessions, we have seen that we have grown in the subject and today at the end of this session, we are going to learn two very relevant and important things and that will add value to the time that you are going to spend as far as knowledge of this subject is concerned. So what are the things that we are going to touch upon in this particular session? We are going to talk about some important terms in accounting, and also we are going to discuss about systems of bookkeeping. So the various systems of bookkeeping that we have in the business. So these are the two areas that we are going to touch upon. Now let's look at the third part. We have already discussed two important terms in accounting. We have already covered transactions. We have already covered events. So let's, brush on those two top concepts. Transaction basically refers to dealing between two parties where there is exchange of money or money's worth. Events are happenings in business which has monetary effect. So we have seen a few examples of transactions, a few examples of events. And in that you found one example, purchase of an asset on the last day of the year becomes an example of both a transaction as well as an event. Let's look at third and very important concept that we have, important term in accounting, and that is goods. What do you mean by goods? Now in common terminology, it is called as a merchandise. If I'm speaking from a manufacturer's point of view, you can call it as raw materials, or from a trader's point of view, any other items, or for that matter, merchandise, which are purchased by a business for the purpose of either resale or for using it in the production or for any other purpose in the business. So goods basically can include raw materials, can include finished goods, can include items which will be used in the business. Raw materials will be used for conversion into finished products, and goods, merchandise which are purchased are readily sold as and when market is available. Now, very interesting fact about goods. In our subject accounts, we don't prepare an account by the name goods account at all. So there is no question of preparing goods account in the accounting books. So if there is no goods account, then what do we do? Which accounts do we prepare? Let's understand that as well. So here we have merchandise, items which are ready for sale, or you can talk about raw materials which will be converted in the factory into finished goods, or we can say stationery materials which will be used in the office of the business. The files, the pen, the notepads, maybe a whiteboard where the conference meetings can be held and some points can be discussed. So there is no account called goods account at all in our subject accounts, but goods are known by 6 names. Which are those 6 names through which we can understand the concept of goods? These are the 6 names: purchases, purchases returns, sales of goods, sales returns of goods, opening stock of goods, and closing stock of goods. These are the 6 names by which we have goods shown in the books of our business. Now, what do you mean by purchases? Purchases refers to goods or merchandise purchased by the business for the purpose of use in production or for resale. So when we are talking about purchases, we are talking about items which are ready for sale. We are talking about raw materials which may be used in production. So items which are purchased, merchandise, for example, is made available for sale. Raw materials which are purchased is made available for conversion into finished product. If you're purchasing any other item, say for example, stock of consumables, say oils, lubricants and all, which is very much required for the smooth running of the business, or stationery for that matter, all these are used in the business. So such items are called as purchases. And point to note, all information pertaining to purchases of goods will be recorded in an account called purchases account. Next we have is purchases returns. What do you mean by purchases returns? See, business has purchased goods from suppliers, maybe merchandise or maybe raw material. Now, while these raw material or goods are being kept ready, either for use or for sale, business finds that there is some defect, there is some damage, or wrong items have been supplied by the supplier. So in that case, the business would like to return such goods back to the suppliers, would like to return such goods back to the suppliers. And since when the business is returning the goods back to the suppliers, the goods are going outside the business, purchases returns are also known as returns outwards or returns to suppliers. So since the goods are going out of the business, such returns are also referred to as returns outwards. Because if we speak about the direction of the goods, it is going outside the business. The next is sales. When we are talking about sales, we are referring to items which were purchased for the purpose of sale. Items which are meant for resale are sold. You may come across an example where an old asset has been sold. Point to note, old asset has been sold and not goods. So sale of goods will be recorded in sales accounts. But if an old asset is sold, that will be recorded in concerned asset account and not in the sales account. Because sales account is focused on the sale of goods and not sale of any other items. So sales refers to sale of goods or merchandise or finished products which were meant for resale. Next, we talk about sales returns. We are selling goods to our customers. The customer finds that there is some defect, there is some damage, or wrong goods have been supplied to them. So in that case, the customer can return the goods back to our business. And since the goods, when the customer is returning, is coming into our business, we refer such returns as returns inwards because goods are coming into our business. So it is called as returns inward. Then we have opening stock. What is opening stock? Opening stock is the balance of stock with which the business begins its accounting period. So goods remaining unsold at the beginning of the accounting period is called as opening stock. And next we have the concept closing stock of goods. Goods lying unsold at the end of the accounting period, which did not find a customer, which were made available for sale but could not be sold at the end of the accounting period is called as closing stock. An interesting point, this year's closing stock will automatically become next year's opening stock. Now, point to note, another very important point, we necessarily don't prepare a separate account called opening stock account and closing stock account. We simply prepare an account called stock account. At the beginning of the year, that stock is called as opening stock. And at the end of the year, goods remaining unsold at the end of the year is called as closing stock. So we don't prepare a separate account called closing stock and opening stock. It is just one stock account. The opening value at the beginning of the year is opening stock and the closing value at the end of the year is referred to as closing stock. So we don't have an account called goods account. Rather, goods account are referred to in the subject through purchases account, purchases returns account, sales account, sales returns account, opening stock account, and closing stock account. So this is about goods and the 6 different names through which it is identified in the books of accounts. Let's move to the next item. Let's move to the next important term in the business, and that is debtors. What do you mean by debtors? Debtors are basically persons or maybe any other business for that matter from whom the money is due to our business. We have given a benefit to our debtor. Let's imagine we have sold goods on credit, say to Mr. Akash. So Akash becomes our debtor because business has to receive money from Akash. So money has to be paid by them, paid by Akash in this example to our business. That's why that person is referred to as a debtor. So debtors basically are people from whom business has to receive. Business has to receive from them. Business has to receive money from them. Now, who are creditors then? These are the persons to whom money is due from our business for the benefit received from them. We have received a benefit from them. Our business has received a benefit from them. And now we are supposed to pay that money for the benefit received to such an outsider, and they are referred to as creditors. So money has to be paid by our business to the outsiders. So these are creditors. Business has to pay to them. Such people are referred to as creditors. So let's get this concept of debtors and creditors right. So people from whom business has to receive money, they are referred to as debtors. So business has to receive. So debtor, you can take it as an example of an asset. As an asset. Creditors are people or other businesses to whom business has to pay money. Our business has to pay money. We have to pay money to outsiders. And the common terminology that we use presently, and that is accounts receivable and accounts payable. Accounts receivable and accounts payable. Now, when we are talking about accounts receivable, we are taking into account two very, very important aspects, and that is called as accounts receivable in this example, accounts receivable. Now, when we say accounts receivable, we are combining debtors as well as bills receivable. So debtors and bills receivable combined together is referred to as accounts receivable. Creditors plus bills receivable in the present time is referred to as accounts payable. So these are the present terminology that we have. One is accounts receivable and the other one is accounts payable. Let's move to the next concept that we have. What do you mean by capital? It simply refers to the money invested by a business person into his or her business, either to start the business or for its expansion. So business person would bring in money at the beginning of the business, and that money is called as capital. So when I say money, it need not be cash alone, because capital can take the form of bank balance as well, can take the form of goods as well, or can take the form of assets. So money invested by a business person into his or her business, either to start or for expanding, he will need more money, so he will bring in additional capital. There is an example. Leshon started business with cash rupees 25,000, goods worth rupees 25,000, and machinery worth rupees 50,000. So the total capital of Leshon in this example would be 51 lakh rupees, 25 in cash, 25,000 in goods, and 50,000 in asset, that is machinery. So total capital of Leshon would work out to 1 lakh rupees. So amount brought in to start a business or for expansion is referred to as capital. The next concept that we have is drawings. What do you mean by drawings? Amount withdrawn by a business person from the business for his personal use. For example, the owner of the business is withdrawing money and using it to pay his children's school or college fees, or for buying a two-wheeler for his son, or for buying a scooter for his daughter for that matter. Those are all his personal expenses. And if the owner of the business is using business's money to meet his personal expenses, such amounts are treated as drawings. How capital can be in the form of cash, bank balance, goods, and assets. Similarly, drawings can also be in the form of cash, bank balance, goods, or assets. And the treatment of drawings is simple. It is always deducted from the capital of the business. So drawings will always be deducted from the capital of the business. We have an example. Neeral withdrew rupees 25,000 worth goods and rupees 10,000 from the bank for his personal use. So 25,000 worth goods is withdrawn, and also 10,000 worth amount from bank balance he has withdrawn, and he has made use for his personal use. So total amount of drawings of Neeral in this example would work out to 25 plus 10, that is 35,000 rupees. And this amount of 35,000 will be deducted from the capital of Niral. How much capital he has brought into his business, that much amount of drawings will be deducted from his capital. That is the treatment. So these are some important terminologies that we are going to use in our discussion as far as the subject accounts is concerned. Now we come to the second topic of today's session, and that is systems of bookkeeping. Systems of bookkeeping, as we have understood, there are two systems of bookkeeping. One is called as the single entry system of bookkeeping, and the second one is a double entry system of bookkeeping. So when I say single entry system, there is nothing much to discuss about this because this system is unscientific, it is incomplete, it is a crude method, or you can say a biased system of bookkeeping. Why do I say biased system? Because here the business person decides what to record and what not to record. So if the businessman feels that this is important, he will record. If this particular transaction is not important, it will not be recorded. So it is the business person who decides what to record and what not to record in case of single entry system of bookkeeping. But when it comes to a double entry system of bookkeeping, it is a complete system. It is universally acceptable by all businesses, whether small or big. And it is an unbiased system of accounting, we say. Unbiased system of bookkeeping. Why do I say unbiased? Because it is the accounting rules that decide. It is the accounting rules that decide that it has to be recorded. So there is nothing called important and not important. Anything to deal with money, anything to deal within the business which has a monetary impact, that will surely be recorded in the books of the business. So that's why we say double entry system is an unbiased system of bookkeeping. Now, if we go back to single entry system, it is combination of single entry, double entry, and no entry. So you may be wondering, what is the single entry? What is this double entry? And what is this no entry? Possibly we will come back again to this particular slide and we will understand. So as far as double entry system is concerned, record everything in the books of accounts. Here under double entry, businessman does not decide. Rather, the accounting rules decide that it should be recorded. Remember this. That's why we call double entry system as unbiased system of bookkeeping. Let's get into what exactly is double entry system of bookkeeping. Every transaction or an event, we have discussed about these two concepts in our previous session, has two aspects. Every transaction in the business has two aspects. One aspect is called debit aspect and another one is called as the credit aspect. What is double? Double means two. Double means two. Recording of both the debit as well as the credit aspect for all the transactions. Imagine if we are talking about one transaction, there are two aspects for every transaction. One is a debit aspect and second one is the credit aspect. And what does double entry system of bookkeeping say? Recording of both the debit and the credit aspect for all the transactions in the books of accounts. It is referred to as double entry system of bookkeeping. So double means two. Both the debit and the credit aspect for all the transactions are recorded. Imagine if there are 10 transactions. So we will have 10 debits and 10 credit aspects. So we will record everything under double entry system of bookkeeping. So as I mentioned previously, accounting's rule decide what has to be recorded and not the business person. So it is the accounting rules that tell us that this has to be recorded. Now, if I go back to single entry system of bookkeeping, here we saw it is a combination of single entry, double entry, and no entry. Meaning, from the businessman's point of view, for a few transactions, he will record only one aspect. So single entry. For few transactions, he will record both the aspects. So double entry. And few of the transactions, he will not record any of the aspects. So no entry at all. That's why we say single entry system is a combination of single entry, double entry, and no entry. But when it comes to double entry system of bookkeeping, both the debit and the credit aspect for every transaction is recorded in the books of accounts. That's why it is called as double entry system of bookkeeping. And as per section 209 of the Companies Act of 2013, it says all businesses must compulsorily follow, especially companies' books of accounts must be recorded under double entry system of bookkeeping. We say all businesses in India or anywhere in the world have to compulsorily follow double entry system of bookkeeping. So I hope the concept of systems of bookkeeping, both single entry as well as double entry system of bookkeeping, is clear. So that's all I have in this particular session. Thank you very much for your patient hearing. So if you would like to connect with me, here you can find my email, and also I have given my mobile number. So feel free to connect with me. And if you have liked the video, you can subscribe, you can comment as well, and do share with your students, especially those who have taken up commerce, maybe at the +2 level, PUC level, BCom, BBA, or for that matter, CA foundation as well. It will definitely be helpful for them. So do share this, and it will benefit a large number of young people in the society. So once again, thank you very much for your patient hearing.